A transaction is an event occurring in a business that results in a financial change. Each transaction has to be accounted for on the books of the business. First, we will examine a typical beginning of a business, the owner investing $2,000 in this new business. Every transaction affects two or more accounts. The first step in analyzing a transaction is to decide which accounts have been affected. The second step is to classify the accounts as assets, liabilities, or owner's equity. Step 3 is to determine whether the accounts are increasing or decreasing. In this case, the accounts that are affected are cash and capital. In this case, cash, the asset, is increasing by $2,000. Capital, the owner's equity account, is increasing by $2,000. Recall the accounting equation. Assets equals liability plus owner's equity. Assets have increased by $2,000. Owner's equity has increased by $2,000, so therefore the equation remains balanced. Let's look at another transaction. The company purchases a computer on credit for $2,500. What two accounts are affected? The equipment account and the accounts payable, because we didn't pay cash for this computer. Equipment is an asset account and accounts payable is a liability account. The equipment account increases by $2,500 because we now have a computer, and the accounts payable increases by $2,500 because we owe that money for the computer. Examining the accounting equation, assets equals liabilities plus owner's equity, we can see that assets have increased by $2,500 and liabilities have increased by $2,500, so that the equation is still balanced. Now for a third example. The company purchases supplies for $50 cash. The two accounts affected are office supplies and cash. Office supplies is an asset account and cash is an asset account. Office supplies increase by $50 and cash decreases by $50. Looking again at the accounting equation, assets equals liability plus owner's equity, you can see that assets have increased by $50 and decreased by $50, so therefore the equation remains balanced. Our last example uses more than two accounts. The company purchases land for $100,000 and pays $25,000 cash and owes the remainder, $75,000, as a mortgage. The accounts used for this transaction are cash, land, and mortgage payable. Cash and land are both asset accounts, and the mortgage payable is a liability account. Land increases by $100,000. Cash decreases by $25,000 and the mortgage payable increases by $75,000. Again, examining our accounting equation, assets equals liability plus owner's equity, you will notice that assets increase by $100,000, decrease by $25,000 because you've paid out cash, and your liabilities, the mortgage, increases by $75,000. Both sides of the equation remain the same and the account is balanced.